Bitcoin is trading defensively. For weeks now, price action has been compressed inside a wide but frustrating range. Every rally feels heavy, every dip attracts buyers, but not strong enough buyers to ignite expansion. At the time of this report, Bitcoin is hovering around $66,000. Ethereum remains below $2,000, and the market tone is cautious. On-chain analysts from Glassnode describe the current structure as a structurally defensive phase. But what does that actually mean? And more importantly, is Bitcoin preparing for a breakdown, or is this simply consolidation before the next expansion cycle? Let's break this down step by step. The structural framework. Glassnode highlights two critical long-term reference levels: the true market mean near $79,200 and the realized price around $55,000. These are not arbitrary lines. The realized price represents the average cost basis of all circulating Bitcoin. Historically, this level acts as deep structural support during corrections. The true market mean reflects broader capital positioning across cycles and often defines the upper boundary during transitional phases. Right now, Bitcoin is trapped between them. That tells us something important. The market is not in capitulation, but it is not in expansion either. Instead, it's absorbing sell-side pressure. That absorption phase is what analysts call defensive. The 60K to 72K corridor. Bitcoin has repeatedly bounced between $60,000 and $72,000. This price band defined much of the first half of 2024. Support has been reliable, but resistance has been equally persistent. The reason? Overhead supply clusters. Between $82,000 to $97,000 and $100,000 to $117,000, large volumes of Bitcoin were acquired in these zones. Those coins are now sitting at unrealized losses. When price approaches those areas, holders are likely to sell into strength. That creates natural resistance. This isn't speculation, this is on-chain distribution data. Markets struggle when large holders are waiting to exit. That supply overhang limits relief rallies. Short-term holder weakness. Glassnode notes that short-term holder profitability remains negative. Short-term holders are typically the most reactive participants. When they are underwater, conviction weakens. That creates three problems: reduced follow-through buying, faster panic selling on dips, and lower probability of breakout continuation. Strong bull cycles require expanding profitability. Right now, we have stabilization, not expansion. Institutional flows turning defensive. Beyond on-chain data, off-chain flows confirm caution. Digital asset treasury flows, including ETFs, corporate holdings, and government allocations, have flipped into net outflows. U.S. spot Bitcoin ETFs recently saw a single-day outflow of approximately $410 million. That matters. ETF flows act as a major liquidity channel for institutional exposure. When redemptions accelerate, it reflects reduced appetite for risk. During the latest sell-off, spot volume spiked. But here's the key detail: it faded quickly. That tells us the buying was reactive, not strategic accumulation. Sustained bull runs require persistent spot inflows. Right now, we are seeing repositioning, not expansion. Futures and leverage reset. Perpetual futures premiums have compressed toward neutral. This means leveraged traders have reduced exposure. There is no aggressive long buildup. That is actually healthy in one sense. It reduces liquidation risk. But it also signals hesitation. Markets expand when traders lean into conviction. Currently, conviction is cautious. Options market signals. Options markets confirm defensive positioning. Implied volatility remains elevated. The 25 delta skew is deeply negative. That indicates persistent demand for downside protection. In simple terms, traders are buying insurance against drops, not betting aggressively on upside. Dealer positioning in short gamma territory is amplifying intraday volatility. That explains sharp intraday swings.
Price is reacting to hedging flows, not trending. Macro backdrop. Now let's zoom out. The Federal Reserve policy rate remains between 3.5% and 3.75%. The U.S. 10-year Treasury yield is hovering near 4.1%. The U.S. dollar index sits near 97. Liquidity conditions are not aggressively loose. The Fed's balance sheet remains well below pandemic peaks. That means financial conditions are not expansionary. And crypto thrives on liquidity expansion. Without it, upside momentum struggles. Stablecoin liquidity paradox. Stablecoin market capitalization stands near $307 billion. That is significant dry powder inside the ecosystem. Yet sentiment indicators remain in extreme fear. Capital exists, but it is not rotating decisively into risk. This divergence is critical. When fear dominates, liquidity sits idle. Rotation is what drives cycles. We haven't seen it yet. Range scenarios. Some analysts believe Bitcoin may remain inside a broad $52,000 to $70,000 range unless a clear catalyst emerges. That is consistent with current structural signals. No breakdown, no breakout, just compression. Diverging institutional views. Major institutions disagree on near-term direction. Standard Chartered warns Bitcoin could fall toward $50,000 before rebounding. J.P. Morgan sees production cost support near $77,000 if reclaimed. Bernstein describes this downturn as the weakest bear case in history and maintains a $150,000 target for the year. These are credible institutions, but their time frames differ. Short-term caution, long-term optimism. Both can be true simultaneously. What would change the structure? For expansion to resume, we need sustained ETF inflows, spot volume growth on rallies, positive shift in short-term holder profitability, futures premiums rebuilding moderately, macro liquidity easing. Without these shifts, upside remains capped. Is this a bear market? Data does not show capitulation. Realized losses are controlled. Long-term holders remain stable. Mining stress is not extreme. Leverage is not overheated. This looks more like consolidation under macro pressure, not structural collapse. Psychological phase. Markets move in emotional waves: euphoria, denial, fear, stabilization, expansion. Right now, we are between fear and stabilization. That is uncomfortable, but historically, these zones build the base for future moves. The bigger cycle context. Bitcoin remains above its realized price. That is historically bullish. Each prior cycle spent time consolidating above realized cost before expansion. Patience defines this stage. The risk case. If ETF outflows accelerate, if macro tightens further, if 60,000 breaks decisively, then downside toward 55,000 becomes plausible.
That aligns with structural support. The bull case. If liquidity improves, if ETF flows stabilize, if 72,000 breaks with volume, then 79,000 becomes viable. Breaking above true market mean would change narrative momentum. Bitcoin is not collapsing, it is compressing. Supply overhang limits rallies. Weak institutional demand reduces fuel. Macro headwinds prevent acceleration. But structural support remains intact. This is what a defensive phase looks like. Slow, choppy, emotionally draining, yet historically transitional. The market is absorbing, not exploding, and not imploding. The next expansion, when it comes, will require conviction, liquidity, and catalyst alignment. Until then, patience defines the cycle.